Hey everyone, me Kevin. Welcome back to episode 26 of the Meet Kevin Show. Today, we have the privilege of speaking to co-founder and co-CEO George Arison of Shift Technologies. This is a used car company that focuses on online reselling of vehicles, big competitor, or will be a big competitor, I believe it, against Carvana and Vroom. We're going to talk about everything having to do with the stock. I'm super excited about this company, very, very bullish, and I want to hear it. All answers to all of the questions that we have directly from co-founder and co-CEO George. Welcome aboard, George. Thank you so much for being here.
Thanks for having me. Excited to talk to you.
Absolutely. So I want to get started. Why is Wall Street not pricing you at the multiples of your competition? You guys are dirt freaking cheap.
Well, I'm not going to comment on stock price as a rule, but I think it's reasonable to say that Carvana is much bigger, right? So it's going to have a higher multiple. I think if you go back to past times, Carvana's multiple was not as high as it is now, which is justified because they've grown so dramatically and they've had a really great run. That said, we are doing awesome. Our business is going to grow about 120% in terms of units and 130% in terms of revenue this year at least. And so we're really excited about where things are, and we're on a really great trajectory, to scale the business in a great way between now and whenever time comes.
Is the biggest thing advertising and just getting in front of people? I see your TV ads almost every day on CNBC.
Yeah, so we historically Shift has not done a lot of marketing. That's been a kind of weak spot for us. Partly because we didn't have the money to do it, partly because we wanted to see how far you could get with digital, and we became really good at marketing through digital channels. But we're also, focused very much on the local business, right, in each market we're in, which then leads to kind of less television, less brand. Frankly, like if we had had the cash in 2018 or 2019, we probably would have put a lot more dollars behind brand building, because it became clear at that point that you needed to build more brand to be successful in scaling the business. But we didn't have the ability to do that. So one of the thinkings behind a SPAC process and being able to raise more money than a traditional IPO was to have the dollars needed to scale brand marketing. We have, as you said, since then have gone on television and have been doing pretty aggressive marketing on TV. We did a ton of research, and it became clear that going national was cheaper than buying local in each market we operate in, and so that's an advantage of going national. And we think we're going to see really great results. If you look at our peers, or if you look at other verticals that are kind of similar to us, building brand has had a lot of great success and has really driven results for everybody. And so we expect the same thing. I mean, it's early days. We only started doing this in kind of early to mid-February. So I can't say, hey, results are here yet. It's still not quite there, but we're excited about what we're seeing in the early indications so far.
Nice. Yeah, and I've noticed your local reviews are very strong, certainly even relative to your competition. And in the used car space, I feel like it's even harder to get great reviews. It's a process that has been sort of bogged down by maybe a reputation that hasn't been so great. But it seems like you all are performing very well. But when you do these local, when you have this local branding, it's almost free when you have these reviews. This is a national advertising campaign. This has got to cost a lot of money.
Word of mouth has definitely been a big driver for what we've been able to achieve so far, but that'll only get you so far, right? And it's also slower because it kind of, you get one good customer and then he tells or she tells 3, 4, 5 other good customers, but it's not as fast as really building brand. We have, for example, spoken publicly about the fact that in San Francisco, where our brand is more known because we've been here longer and we have more adoption as percentage of total customer base, right. We have the ability to scale faster because our brand is stronger. And so part of the thinking behind having a brand marketing effort is to actually get other markets to match more where San Francisco is, while pushing San Francisco forward in being known. I mean, I think it took me a long time to kind of fully cognize that this was needed, because I'm not a marketing guy, and I came out of the technology world, having spent time, in building another company and then at Google. And so it made sense that you'd go digital only. But the learning over the last 6 years that if you don't build brand, you won't succeed. And I think our peers, Carvana, Vroom, have been ahead of us in that getting that started,
Sure.
which I think makes sense. They're also a little bit bigger and older, but now that we have the capital, actually investing in that makes a ton of sense, and we should make sure that we do that in an aggressive way.
Yeah, and like, so are you using the ads on television as sort of brand awareness building? Is it something where is it a loss leader, so to speak, or is it profitable to run these national ads?
No, so I can't speak on whether it's profitable to run an ad or not. I think the way we think about marketing is an integrated view, right? So I think what's happened is before people would think of brand building as like, hey, I'm just doing brand building, and then there's digital where I'm acquiring customers one at a time. I think that view is really, frankly, collapsing. There's a ton of data that shows that this is all integrated and interconnected. Brand building can drive immediate customers, even though you can't really measure that, right? And digital helps build brand and vice versa. But I think the reality is that the power of TV, and I don't mean just cable, I mean also, kind of OTT, all kinds of TV, because a lot of people are cord cutting. So when I say TV, I'm not talking about just like, hey, I'm watching television via Comcast or whatnot. It's super powerful, and I think it's way more powerful than we give it credit for in building awareness, and then that awareness driving results over 6 months, 9 months, 12 months. But we looked at a ton of data that shows that digital conversion increases because you are on television, for example. So the same type of ad you might be running on Google or Facebook actually has higher conversion rates when you are on TV as well versus when you don't.
Oh, wow. Yeah, because I was going to ask you about that. I mean, we've got Facebook where you can track, links and actions on the web page. Same with Google. So you're saying the impact of that money spending actually goes up when people are like, oh, I saw them on CNBC, on a TV ad or whatever.
Yeah, no, exactly. And it's not just that I saw the ad. It's like, we had a customer literally mention the other day that my brother-in-law in Idaho saw your commercial, and that's what convinced me to buy a car from you.
Wow.
Right.
Sorry, go ahead.
No, so it's hard to measure, and that's one of the reasons why people don't like brand. But the power of brand is really massive, and in certain industries, it's a lot more intense than in other industries. And in ours, it is more intense. I think partly driven by the fact that OEMs are doing so much marketing for what they do, right? The kind of manufacturing cars, et cetera, that it kind of passes on to us a little bit as well.
Now, one of the things that I've thought about the used car industry is that it might be a little bit difficult to have brand loyalty, where the biggest selling factor is going to be who's going to pay me the most for my car. Like if I'm selling a used car, I care about who's going to pay me the most. Now, in your case, I would love for you to comment on this. In your case, I actually see that as a benefit because, look, maybe Carvana is more known because it's been around longer and it's more, ubiquitous. But if you pay more, I don't care about Carvana. I'm going to you. Can you speak to that a little bit?
Absolutely. In terms of a seller, the number one and number two and number three thing that they care about is probably how much money they're getting on the car. Now, I also do think they care about the convenience, right? Like if you're trying to sell a car, the simplicity of it also matters. And I think our convenience is very much there, right? Like in the markets where we have operations, San Francisco, LA, Seattle, Portland, et cetera, San Diego, we can come to you, within 12 hours or 24 hours, pick up the car, take it away, and you never see it again. So that I think that's a huge value. And then another factor that really does matter to people is being able to get the certain price when they price that vehicle. And that's another thing that we do, I think, really well, which is when you submit your car information to us, we're able to give you the price, and that's kind of the price you're going to get for that car. So I think those two things really do matter to consumers quite a bit, in addition to the price. But obviously, price really does matter. Price here is determined fundamentally by what are you able to sell the car for, right? Like how much can you generate? Because ultimately that's what you're doing. So, and there's two prices in the automotive industry. There's a retail price, meaning what is the consumer able to get for a vehicle, or what is the consumer going to pay for a vehicle? And then there's a wholesale price where you sell a car to another dealer or a wholesaler or somebody else. And so in our case, because our inventory is so broad, because we sell cars from, nearly 0 days in age, like, let's say a week or two after they were bought initially brand new to
Yeah.
12 years in age, we have a really broad inventory that allows us to offer sellers a retail price for the broadest amount of cars that are out there. So whereas, a dealer might say, hey, I'm selling you a 2-year-old car here as a certified pre-owned, you're trading in a 10-year-old car, and I'm not going to sell this 10-year-old car to another consumer. I'm going to have to take it to auction in order to get rid of it. And so your trade-in price is really low as a result. In our case, we can turn around and sell that 10-year-old car to another consumer because our inventory spectrum is so broad, and then get you a better price as a result. So that's an advantage kind of to what we're doing in how we do it by having this really broad breadth of inventory.
Hey, now, on that, there's been commentary that maybe you stay out of the luxury market, though. Is that so? Are you referring to broadness sort of under a certain price threshold?
No, I think that's a misperception. We actually do luxury really well, and you can imagine why, right? With this idea of a high-touch service that shows up in front of your house with the car, you can spend 20 minutes driving in it before you buy it, and then transact on an iPad. That's ready-made for luxury. And frankly, when Shift got started, luxury was probably vast majority of what we were selling in the earliest days of the business. Like 2014, 2015, I would guess like 50% of our sales or close to it were in some form of highline or luxury vehicles. And it actually took us time to get more into the, core vehicles, let's say, kind of the Toyotas and the Corollas in a more aggressive way. So we still do, luxury vehicles quite a bit. In certain luxury brands and makes, we actually over-index massively versus their sales in the population overall, meaning we sell a lot more of those than as a percentage of total sales. We do luxury really well. What we have not been doing as much of, though, is newer vehicles, kind of 1 to 3 years old. And so the, kind of the core vehicle that's 1 to 2 or 3 years old, historically, we've done less of. And the reason for that is that you do less well in what's called front-end margin on those vehicles. So you make less money on the metal. There's very little margin on the actual car sale. So you buy that car for $20K, you put in $500 of reconditioning, so you've spent $20,500. You'll probably sell at most, for $21,500, maybe even for $21,000. So your margin on the car itself will be very low. Most of the money that you make on that car is going to be on what's called F&I. So financing and insurance, in originating financing, and in having the customer buy a vehicle service contract, buy gap insurance, tire and wheel, things like that. And on those vehicles, you can actually do really well in the F&I, much better than in the more later stage cars. Again, which all logically makes sense. But in our case, we were not doing as well in F&I as a company, say, 24 months ago as we are today. For example, in Q4, right, our quarter-over-quarter growth in F&I was 60%. So we're at about 790 average F&I today in Q4 versus a year ago we were 60% lower. So we needed to get much higher F&I numbers before we felt comfortable doing these 1 to 3 year old core vehicles, right? By core, I mean like a Toyota or a Corolla or a Ford. So as F&I has improved, we've been more willing to buy those types of cars and sell those types of cars because we don't feel as nervous about the front end margin being lower, because we can make up on the back end margin, on the F&I margin. So today we do more of those. A year ago we might have done less of those. But Shift's kind of breadth of inventory, I mean, there's no question that we sell the broadest range of cars and the most in line with where the consumer demand is. And that's just driven by this additional kind of 6+ year old cars where we do really, really well, and that are a huge part of our overall sales.
How much AI are you using to help you determine exactly where that demand is? I remember in one of your earnings calls you had talked about, or one of your staff had talked about, targeting convertibles in SoCal and electric vehicles in NorCal. Can you speak to that a little bit?
Yeah, absolutely. So we do spend, a lot of engineering time and effort over time with the company and today on our pricing algorithm. I've always said it's kind of like our search engine. It'll never be perfect. We'll always be making it better. And that's at the core of the business. If you get pricing wrong, you really kind of screw up, right? And pricing includes
you're screwed.
What kind of cars should we buy and when, right? Like, do we, so there are certain vehicles that sell really well in California. Prius is an example. I don't think it's a surprise to anybody. Whereas, other cars might sell really well in other parts of the country. For example, Texas is much more active in selling trucks than
Priuses.
than Priuses. And we carry very few trucks in California especially in Northern California, because consumers just are not as active in buying those vehicles, whereas we might have, a lot more trucks in Texas. So I think we do use data and machine learning a ton in deciding what to buy and how to buy it and when to buy it. It's really crucial to what we do as a business and how we approach, our operations. There's a lot more you can do that we are not yet doing because there's always, a limited amount of things you can do at the same time. I think the world I really want to get to is where when I go to the website, the vehicles I see up front and center are different from the ones that you might see when you come to our website based on best preferences and things that we know about you, right? Because we should make shopping be a lot more personalized right away versus what it is today. And that's true not just of Shift. I mean, I think that's true across all businesses. You kind of want that experience, and we're not fully there yet as an industry, kind of in retail commerce to do that. We still rely too much on you being able to decide what you would like to or you telling us what you want to buy versus us helping you figure that out. And I don't think that's ideal. And so kind of more medium term, what I want to see us be able to do is really take a lead in that kind of more personalized commerce that I think is coming, but is not quite yet there.
God, that's incredible. I mean, you probably the most simple I'm thinking of is IP address. Okay, you're in this area. Well, let's show you this kind of vehicle, huh?
But it's also your cookie history can tell us what kind of cars you want to potentially look at you might. I mean, a lot of people come back to Shift a ton. We have really beautiful pictures of cars. People like to come and look at those cars. Well, if you come to us all the time and you're looking at, BMWs, it'd be smart of us to just show you BMWs when you show up rather than show you everything else, right? And doesn't mean we're going to hide everything else. We can still find other things on the site if that's what you want. But if we can guesstimate what it is that you're looking for, we should, help you. Or if you have a personalization search setup, like I was looking for a car a while back, and I had an alert set up on our site where I would get an email every time something similar to that showed up. Well, probably when I would come to shift.com, we should actually customize the site specifically to your kind of needs around what you already have personalization set up for. This is all doable. It's just a matter of what do you prioritize and where do you do the work and how do you use AI in the right way. We've not done that, and frankly, we're not the only ones, right? Like even in on Amazon, that's not yet happening. Although Amazon does a pretty good job, and people have also seen, or you might also like, etc. And so that I just think long term of commerce is going to head in that direction, and I think there's a great opportunity with vehicle shopping to do that in particular, because vehicle shopping is extremely long process. It's not something done in one day or 1 week. People are out there shopping for a car for 6 months at a time.
Yeah, well, plenty of time to gather data then and compete. I want to know what you know about Prodigy. They were just acquired by Upstart. It was just announced yesterday. I think they're part of that F&I space. Do you have something similar to that?
So Prodigy and there are a few other companies. Autofi, I think, is another one. Are all companies that are aiming to help dealers enable more digitalization in how they issue financing. Okay. I actually don't know Prodigy that well. I know Autofi a little bit better. There's another one based in LA whose name I'm now blinking on, that are kind of all doing the same thing. I mean, it's not surprising, right? There's 26,000 dealers in the United States, and none of them have a digital solution. So the fact that you would have an enterprise product or 2 or 3 or 4 or 5 kind of targeting at the dealer, it totally makes sense and is very logical. I think it's tough because for most traditional dealers, F&I is the kind of core area where they make money because they don't make as much money on the vehicle itself, right? Especially for new car sellers, that's even more of a factor because new cars are pretty much a commodity, right? You have 11 BMW dealerships in the Bay Area. well, all of them are selling the same vehicle. It's not like this dealership is going to sell different cars than the other one. And so they're all forced to compete on price. And so then the margins get really cut on the car itself, and they have to make all the money on the back end. And it's a tough spot to be in. And so giving that kind of, good non-digital solution that works really well for them on F&I, and moving digital is tough. On the flip side, I think all dealers understand that like commerce has fundamentally changed as a result of COVID, and people are not going to go back to how they were doing it before. And so having digital front ends is really critical. Ultimately, I think it's a tough road to hoe, where you're kind of trying to slap on a digital solution on a traditional model. That's always very tough for people to do. And I'm not saying that Prodigies or Autobuys can't work. They actually will make the experience better for consumers. I just don't know how much better that experience is going to be.
So you're saying we should sell GameStops because they're not going to transition to digital?
I'm not going to comment on that. That's on my pay grade.
Well, okay. What about CarMax though? CarMax has recently announced that they are going to, get into this digitization world more. Or do you think they're going to run into some of those struggles of going from the traditional and the weight of all these stores to digital?
Totally. Look, CarMax is an amazingly run company, and the innovation that CarMax has offered to the space, in the 1990s was incredible. I know a little bit about Circuit City from back in the day when I was at BCG, and the founder of CarMax kind of at Circuit City was an ex-BCG, so it's kind of like a legend internally, as like the guy who like became an entrepreneur and was able to create something completely amazing. So I have followed CarMax for a long time, even way before I kind of was into this industry. So CarMax has taught us a ton, and we really admire a lot of what they've done operationally speaking. They're incredible. They're about as good as an operational company as that comes in the space. I think all of us, whether it's Carvana or Shift, who are owning operations in-house and not outsourcing those, right, are kind of trying to emulate them as much as possible on the operational side of things. I think they are never going to be able to become a digital kind of native. That's not possible to do. Sure. We've seen, take cars out of it completely. Like look at traditional retail. Many traditional retailers completely failed, and as a result have gone bankrupt. Some traditional retailers have been able to move forward in this direction and actually make really deep progress. But usually, they invest many hundreds of millions or billions of dollars into trying to become digital natives, do many attempts at it and fail, and then eventually going to go buy a digital native company. And as a result of that, are able to make a transition to becoming a more of an e-commerce company. And that was true, say, of Walmart, and it was true of Target. And so I think that if that's true of normal retailers, I don't know why that would be true of any other kind of retailer. It's really tough when your DNA is built around having physical footprint and having stores to make a decision to transfer to something else. You're also fundamentally cannibalizing your core business, and that's really tough to do as well. Apple might be willing and able to cannibalize its own business all the time, but they're not a normal company that is that everyone else follows, right, in that regard. Apple is unique, and that's why it is Apple. So I just, I think it's a very tough change. I hope they're successful and all the power to them, but I think it's a really difficult thing to go about doing.
What do you think your unique selling proposition is over your competition? I mean, if you're all selling online, does it just come down to price?
No. So first, I don't really view Carvana or Vroom or frankly even Carmax as my competition at its core. I think they're peer companies, and I think all of us are trying to do something innovative. And if you add up all our volume and double it, we're not even going to be 2% of the 2% of the industry, right? So we're not really competing with each other. Sure, are there kind of early adopter customers that might go to all three websites and get a price for their car, or vice versa, look for the same car on all three websites? Absolutely. Does an average consumer who's trying to buy a car and is short on time and is not really in there experimenting going to do that? No. 99% plus of sales is going to happen through channels other than Shift, Carvana, and Vroom. And so that's where real competition is, and that's where we're really capturing share. Frankly, I think each one of us marketing is helping the other company, meaning Shift marketing helps Carvana and Vroom, Carvana marketing helps Shift and Vroom, et cetera, because we are not only marketing our brand and our product, we're also marketing a different way to buy, and people learning about that, I think, is really, really helpful and really good. So I, generally don't view them as competition. I think that they're a peer set that I really admire, and I think we all have, different ways of going about doing what we're doing, but we're fundamentally trying to do the same thing. We are different models. The way I tend to describe this is from the operational perspective. So like if you're an investor kind of trying to break down the companies, Shift and Carvana are actually quite similar, and Vroom is quite different. Shift and Carvana both believe that having most things in-house is really critical. We are kind of a full stack business. So Shift owns its own local logistics. We own our own reconditioning. We own our own sales team and customer service. Like everyone's an employee, everyone's W-2. Now that comes with its own challenges, but from the operational excellence perspective, you kind of need to do that. Carvana's in the exact same place. They own the full stack of everything. They go a step further in as much as they have a captive financing, product where they offer financing to consumers on their own. We don't yet have a captive financing product, and we haven't made a decision on whether we'll have one or not, but we're also not big enough to book one yet. So then, we'll talk about that in a couple of years. Vroom, on the other hand, has been in the view of like not owning each one of these pieces and kind of trying to use an outsourcing model for that. I've tried that. Like if you go back to things I've talked about in 2014, 2015, I was a big advocate of outsourcing for, say, reconditioning. I also did not have full-time concierges and whatnot delivering cars to people. And I really thought that we could be kind of the Uber of this space, where it was like all distributed, all 1099, all partner rather than employees. And we basically learned that you couldn't do that. You had to make people be in-house, be full-time, be well managed, because operational excellence is so critical and so instrumental. And so I kind of have done the third-party thing, been there, done that, it didn't work. And so I think we kind of learned our way that this is how you need to do it. So that's kind of how I break down the businesses from the operational standpoint. From the consumer experience standpoint, though, Uber and Carvana have more in common with each other, and Shift is kind of a little bit stands apart. So their model fundamentally is buy the car sight unseen online, right, or on a mobile app, and then the car will be shipped to you for delivery, and it will be delivered on a flatbed truck. We allow you to do that as well. So if you're in New York and you want to buy a car from Shift, great, you can buy a car and we'll ship it to you. In a similar way to what Vroom might do. However, kind of the core part of our business and what we do vast majority of is sell to consumers in the markets where we have operations, which are currently markets all up and down the West Coast, and we'll be launching in Texas in the near term. And there we offer you to be able to book a test drive, and we'll bring the car to you same day or next day to see prior to purchase. And for a lot of consumers, that's a differentiated and unique experience of the car being delivered to their house to see prior to them buying it, which consumers really want, because I think most people want to see the car prior to purchase. That allows us to have a unique kind of differentiation in the inventory that we sell, because older inventory buying without test drive is really tough to do. And then there's a unique niche of like showing up at your house with a car prior to buying it. So obviously some consumers choose to buy a car sight unseen, and that's awesome. And we completely encourage that if that's what they want to do. But other consumers, prefer to see the car first. And we're the only ones of the e-commerce players that allows you to do that. And frankly, we're the only ones of the offline players that allows you to do that, where you can actually book a test drive and have the car come to you. Carmax is starting to offer that kind of test drive delivery. But as of right now, my understanding is, and I could be wrong, but last time I checked, you had to apply for financing and be approved for financing prior to being able to book a test drive. So, frankly, that's a pretty steep step before you get a test drive. We obviously encourage you to apply for financing, and we think it's great if you do, but we don't require you to do it. So, it's an option. We think that the value prop of that is really massive, and consumers really love that. And so that's why we do it. And we expect our buy online, sight unseen, and have it be shipped to grow, because we've only started to offer that for about the last year and a quarter. So over time, it's been kind of growing for obvious reasons. And as our brand becomes more known and more trusted, more and more people will kind of trust us to do that part of the experience. But we do expect the test drive to remain really critical and instrumental to consumer behavior, for the near term and the medium term, because people really need to see the car prior to purchase.
What's your average customer? Age, demo?
We've not released kind of very detailed numbers on that. What I've talked about historically is that we really over-index on millennial and younger, like in a pretty massive way. I think they're by far the majority, and more than a majority of our buyers. People have this notion that because you sell on average lower average sale price of the car, you must have a lot of subprime customers. That's actually not really true. Vast majority of Shift users are prime and near prime. Obviously, we have some subprime customers, but we don't really then we're not their first place to shop because we don't have as many subprime lenders as somebody else might. And so we actually don't really kind of target that demo in an aggressive way. That's something we're working on, to add more subprime lenders to us, so we can offer them better financing. But we're not there yet in terms of being fully kind of enabled with many subprimes. We have a couple, but we don't have as many as are needed. So most of our buyers are prime and near prime. And then I think the last comment that I can make on that is our sellers and our buyers are actually not the same. Our buyers are usually more our sellers are usually more kind of higher income versus our buyers are more medium income, which makes sense, right? Like as a more higher income seller is kind of focused on, hey, I just want to sell this car, be done with, versus the more in the middle class or lower income category, somebody who's selling a car might try to maximize their money as to the extreme, which is fine. I think the way I've always thought about Shift, ever since we kind of started offering this test drive delivered to the consumer, is Tesla offered this incredible new car buying experience starting in like 2012, 2013, when Shift was just getting started. And I'm like, that's awesome, but you're buying a $130,000 car. Like, can we create that type of a consumer buying experience for a $15,000 car or for a $20,000 car? And that's what we've been trying to do, like democratize this really incredible user experience, which is frankly, what like most digital commerce home delivery companies have been trying to do as well, right? Like the idea of having food delivered to you and you can do it for $5.99 or $9.99 is really incredible. And you're getting an experience that previously might have cost you $30 or $40, and so only the wealthy could do. Now a much broader spectrum of the population can do. And I think that's what's unique about the internet and how it's played into kind of the home delivery segment of the economy.
It's kind of like the white glove version of Wayfair for furniture. I want to ask you, are you trying to then cater some of your acquisitions to, and it would make sense if you do, to millennials? For example, you don't take smoker cars, I believe.
Yeah, I mean, I think that's not so much targeted millennials. It's more, it's really tough to sell that vehicle because it's really hard to get the smell out of the car, and consumers don't really like that. And so I think that's more of a challenge rather than kind of targeting them. But I mean, I think one of the reasons why, for example, we do really well with certain luxury brands, and I'm not going to mention specific brand names, but just kind of thinking about it, people can guess, is because millennials really love those cars, right? And so when you're a younger millennial or kind of in that cohort of age, okay, I'm buying this, luxury vehicle. I probably don't want to buy new because I don't want to overspend, but I really want to treat myself to a luxury car. Well, Shift's a really great place to do that at, right? So I think that works really well for us, and we've generally been very happy with it.
What about companies like Tesla offering clients to buy cars and then resell them? I mean, their goal is obviously to sell them a new one, but that now gives them this used car inventory. And in a sense, they are then a competitor to you. Is that a concern, or is their pricing just bad? Any thoughts on that?
No, look, the idea of a new car seller, usually it's a franchise dealership. In Tesla's case, it's Tesla. Doing a trade-in has been happening, for forever, frankly, and it's a core part of the value proposition from the simplicity standpoint. Trade-ins account for about 30% of the use. So 30% of a new car purchase involves some form of a trade-in in the industry. So it's pretty high. In some states, it's much higher. Some states have a tax advantage when you do a trade-in as well. So if you're buying a $20,000 brand new car and you have an old car that's worth 10, you actually only pay taxes on the difference, not on the full amount. That's not the case in California, for example, but in other places it is. So trade-ins are kind of a big part of the industry. They've been around forever. It's not at all surprising that Tesla would do that, but so does BMW and so does Audi and whatnot. Every franchise that I know of does that. That's totally fine. And we are but the market is really massive, right? So if 30% of the new car purchases have a trade-in, and there's let's say on average somewhere between 15 and 17 million new car purchases a year in the US, that still leaves many million new car purchases that don't have a trade-in. So right. Number one. Number two, 15 million used car sales a year, ballpark, 13 to 15 million, are done private party. So these are like, wow. You and I find each other on Craigslist and then do a transaction. Those experiences are really terrible experiences, frankly, for consumers in a lot of ways. That's the kind of thing that got me really motivated to go after this industry, because it's really tough to obtain financing in transactions like that. So people get a good deal, price is really good, but it's really tough to finance a car when you're doing it through a kind of Craigslist transaction. And so our thinking has always been, hey, we want to offer sellers not quite as much money as they might make on Craigslist, but close to that as possible, while giving them a way better experience, and then give a buyer a really good deal while giving the buyer a really good experience. And I think we've done that. So because our inventory is so broad, and because we have so many cars in the kind of 6+ age range, that actually allows us to really go actively after a seller and a buyer who might otherwise transact on Craigslist, because most of the Craigslist transactions or the private party transactions are in that kind of 6+ age range. And so you can't really capture the private party market unless you're offering all the vehicles. And that's one thing that we do, I think, really well.
You mentioned 13 to 15 million private car sales. Is that just in the United States? Because if it is, that's I think we sold like 17 million new cars in the United States in 2020. That's a huge segment.
No, so US car sales is, on average between 15 and 17 million new cars. And I say on average because different years bring a different number. When the economy is doing great, it's a higher number. When the economy is doing poorly, it's a lower number. And then somewhere between 40 and 45 million of used car sales. And the used car sales market is broken into kind of 3 categories. A third of it is dealer sales to consumer, and a third of it is private party, and a third is wholesale sales. So these are sales between dealers or dealers to abroad, et cetera, like kind of other types of transactions, or off lease cars, right? So you have a lease, you bring the car back to a dealership, that dealership then gives it to the OEM takes it to an auction, sells it to somebody else. So that's a third of the market as well. So it's a massive, massive market. Dealer sales are roughly equal to the consumer private party sales. And so both are pretty big markets. Now, not all of the consumer sales are viably captured by a dealership, whether it's an e-commerce dealership like Shift or a normal dealership, because some of them are very old cars, right? Like a $2,000 or a $3,000 car. You could wholesale that car for sure, but you can't. Like, we would never sell that car to another consumer because there's just not enough margin to be made for that. We usually don't do cars below $7,000 in price. But majority of the private party market is something that we can go after.
Nice. What about how are RoboTaxis going to affect the used car market in the future?
It's interesting. I've not thought about kind of these things in a while now, because for a while, when I was doing like my Series A or my Series B, I would get asked these questions all the time, and then because I think when we were getting started in 2014, 2015, there's this like meme of like, oh yeah, self-driving cars are coming in 5 years, and you're like, no, they're not. They're going to be like maybe 20 years. Let's realistically talk about that. The answer I would always give folks, and I think it's the right answer, is that even if we assume that the market for transactions, meaning car ownership, falls, say, by a third, ultimately the branded larger companies like a Shift or a Carvana or a Carmax are going to be a winner, while the smaller mom and pop shops are going to be the loser. Because if a mom and pop shop is doing 50 transactions a month, and suddenly loses a third of those transactions, they're probably not going to survive. But somebody has to capture the 2/3 of the transactions that were happening, that are still happening, right? And the branded business are going to be more able to capture that. And so the shrinking of the market overall, whether it's used car market or new car market, because of the self-driving cars or whatever might happen, won't actually hurt us. It might actually dramatically help us in consolidating the industry further. That is not to suggest that I believe that the market will consolidate. I've been tracking this market now for 10 years and I'm not seeing, sorry, not consolidate, but will shrink. I'm not seeing the evidence of that. If anything, in the Bay Area, where prior to COVID, Uber and Lyft were kind of the most successful of anywhere in the United States, right? Like there was a huge portion of the traffic that was happening. We've seen car sales increase, not decrease. While concurrently with, you know, those things kind of growing as well. So I think that fundamentally for the foreseeable future, the next 10, 20 years, Americans will want to own vehicles. Our country is set up in a manner in which owning a car is super convenient and necessary. Sure. You know, people have families. People, when they have families, move into suburbs. Good luck not owning a car when you're in the suburb. Like, right. We're actually not a heavy driver. Like, I don't drive very much. And when we lived in the city, I never thought about owning a car per se, for a long time. And then we moved to the suburbs and like, wow, like we need a car. And you know, so it's inevitable. And then like, you know, think about putting the child car seat into every car that you might rent or get. Sure. Get taxied, whatever. It's like really complicated. So people need cars. People want cars. I don't think that's going to change. But even if it does, and the volume of production falls, I don't think it impacts us that negatively. Frankly, the bigger concern, I think, is what happens to the economy if new car manufacturing falls in a third, right? Like in a world where suddenly you have self-driving cars and we produce less vehicles, that's a really massive impact on the economy. Forget about retail car sales. Like what happens to OEMs? And all the millions of jobs that are tied to with the manufacturing of new cars. I think that's the really bigger issue in that kind of hypothetical versus what happens to car sales.
Yeah, my thinking is actually that the last thing you just said here is so perfect in one of the theses that I've had is that we might see new cars in the car market start declining in sales as these cars last longer, especially as people electrify, right? And sure, we could swap a battery, but the actual car itself, why do we need a new one? We could resell that over and over again. And maybe you go beyond selling, you know, maybe you're selling 20-year-old Teslas in 2040.
Yeah, no, totally. And also like, you know, you can, I think this has not been a key focus of Shift, but like the recycling nature of our business to me is exciting. Like, it's actually environmentally friendly. I don't really talk much about that, but the reality is that it's true. And in a world where you might need to like replace a battery, but the car's still in really good shape, we get to that world, that's actually awesome. The same way that like, you know, if we are able to make other adjustments to the car through reconditioning to make it a better quality, less emissions, etc., to improve it, we can do that. I mean, it's a key reason why having reconditioning there. And then lastly, like someone's going to have to sell the self-driving cars as well, and someone's going to have to service those self-driving cars. Computers break down all the time. Self-driving cars are computers. They're going to break down all the time. So having a massive local infrastructure that is car related will not hurt, will actually really help in the kind of future hypothetical world where there's a lot more self-driving. You know, that all said, like I've been talking about this now for 8 years almost, and people were predicting kind of self-driving cars coming, you know, tomorrow to me for a long time. I remember having a debate about this with somebody, an investor at Web Summit, like in 2016, where he's like, oh yeah, 2 years from now, we're going to have like XYZ happening in self-driving cars. I'm like, no, we won't. And like, we're much further away. And that's still the case. By the way, don't get me wrong. I'm an entrepreneur. I'm a tech entrepreneur and I love technology. I would love to have a self-driving car that, you know, I never had to drive and I could sit in the back and nicely work, right? Like I'm all for that. It's just the reality is we're not there yet. And in addition to the technology needs of making that happen, there's regulatory concerns that are going to take a long, long time to figure out.
I mean, I love the idea though that even if we have self-driving cars, people are still going to own cars and they're going to want to sell these used cars. And if they last longer, hey, that's even better of an argument for the used car market. Have you been in a Tesla, the self-drive? Have you seen some of the stuff they already have?
I mean, we own a Tesla, so we've used the self-driving features, not as much because actually our kids don't. Our kids are 18 and they don't really love it because it's a little bit more like kind of less smooth, so to say, when you're on a highway, which is fine for adults. I think for 18-month-olds, it's a little more.
For 18-year-olds, yeah. I hear what you're saying. Okay.
Yeah, it creates a little bit more kind of pressure. So we don't use it very much, but yeah, I mean, they're amazing. And I think Tesla's an incredible car and an incredible company. Like,
I want to ask you about your partnership with Lithium Motors. Any plans to continue, getting into partnerships with dealerships?
So Lithia is just a shareholder. They're not really doing very much for us today. They led our Series D, and there was a lot of things that we achieved with them through a relationship in 2018, 2019. Today, they still kind of do a couple of small things for us, such as underwrite our floor plan for the next couple of quarters through the end of Q3 of 2021. But from the perspective of just kind of like what happens with them every day, they're just a shareholder, and that's it. I think there are many ways you can skin this cat, and there's a lot of opportunities, but I think what we've achieved is really good, and now we're kind of on our own, and they're on their own. From the point of view of dealer partnerships, though, I've spoken about this publicly, and I think even on one of the SPAC process recordings that has been publicly filed with the SEC. So I think it's okay to talk about this. We've always believed that there's a huge opportunity in offering a marketplace model to dealers. So allowing a dealership to list cars with Shift and then using our logistics and local fulfillment to sell the car. And kind of the way I think about this, if you're a local dealer in San Jose, you attract consumers, 5 to 10 miles away from your dealership. If somebody lives in San Francisco, they're probably not going to commute 35 to 40 miles from San Francisco to San Jose to see a car, because there's going to be many dozens of dealerships between San Jose and San Francisco
along the way
that will have the same cars that they want. But if you could bring the car to the consumer's house in San Francisco or consumer's workplace in San Francisco, then suddenly that's a lot more appealing to purchase that vehicle. And so we can expand the geographic footprint of a dealership by bringing local logistics of delivery to the consumer, to them. And that's, I think, very appealing. I think this is not something for very large dealerships that are going to try to figure out their own technology solutions. But for smaller dealerships, like a kind of 50 cars a month mom and pop shop, it's really appealing, I think. And we've seen this kind of in other parts of the retail ecosystem. The marketplace business in Amazon has been growing dramatically quickly because e-commerce players, the smaller ones, benefit so much from that. And so in our case, I think the same thing would be true. Now, we haven't actively done anything on this yet. Like we've talked to dealers about it, and we've internally talked a lot about that, but we've not actively pushed to build this business. And we're not saying we are going to in time immediately. We got to focus on what we're focused on. But I think there's an opportunity there in the medium term to do something really cool and really innovative, and really expand our inventory availability on our site while offering a really cool product to the dealership ecosystem, especially in the smaller dealers side of things.
How do you, I mean, if you're going to expand these services as rapidly as you are, and you're doing this with a W-2 model where you're really hiring full-time staff, now you're paying benefits, your costs are immediately going up, but the productivity per worker is not immediately up because they're just getting started. Is it possible that you kind of have this delayed profit margin where when you first scale, that margin's going to be lower? And I mean, naturally profit margin should go up over time, but are you delaying it with the W-2 model versus that 1099 model, which you didn't like?
Well, I mean, I think that what I've learned in my, now 7 years of kind of being involved in a very heavily operational company, I don't actually think you save that much money on the 1099 model as people think you do. And you certainly, whatever money you save, you lose in lack of productivity and in employees being unhappy. I think keeping your employees really happy is really critical. And so I don't think that difference between one and the other one is necessarily that significant to really pay that much attention to. Okay. I think people do. And I think for someone like an Uber that might make more of a difference. But for a business like ours, I don't think it does. Now, a separate issue is of like, we have to build infrastructure forward, right? Like when we build a warehouse facility, which, costs some capital expenditure, is not significant. It's kind of, well within reason of and much less than some of our peers in terms of building their, dealerships or their warehouse facilities and their reconditioning facilities. It's a lot lower than that, but we'll invest in them. You do build them forward, right? Like if I'm going to open up a warehouse facility, which we call a hub in, say, Austin, Texas, it's going to take many months for us to fully utilize that facility. So you always have kind of unutilized facility. That's just the reality of a growth company, right? Like we are growing infrastructure forward. And so obviously your profitability is going to be delayed because you're growing into that over time. But
you're ramping your warehouses and that.
But I think that's, that's how growth companies are. That's why, most growth companies are evaluated based on their speed of growth and their revenue and on a per unit basis, kind of where they are on a unit economics basis, rather than, hey, are they fully profitable or not profitable? Because it's a different consideration. There's different types of companies that kind of are evaluated differently. And I think, I'm not going to speak about chips specifically, but when I look at growth businesses, I'm not focused on their profit margin. I'm focused on their per unit economics and the speed of growth, and can they sustain a really fast ramp of growth for the long term.
How are you doing all the reconditioning? I mean, it seems like that. I mean, I hate to say it, but the reconditioning just seems like so low margin because of all of the different parts you need. I mean, maybe correct me if I'm wrong, but if I'm like, I need a new window switch for this Beamer that came in, like, you gotta order this from BMW. It's expensive. How do you profit on these?
Well, reconditioning is not a profit center for us, right? Like we buy a car, we put in a certain amount of dollars of reconditioning into it. These are made up hypothetical numbers, but like I said, we pay $20,000 for a car, we recondition it for $1,000, and we want to sell it for $22,000 to $22,500, right? So we want to make a margin on top of the reconditioning. That's how every dealer in nature kind of operates. That's what you want to do. You want to put in the reconditioning, increase the value of the car as a result of the reconditioning you put in, and then sell it for more. And that works. Reconditioning is not easy. It's actually probably the most complex part of our business. And you have to have, really strong operators kind of running it. We're fortunate to have them, and we've recruited them from, the best places where you can find reconditioning experts. Yes, when you scale and you're bigger, there's no question that you see leverage on your business, because you're able to buy parts for less money. You're able to utilize your workforce a lot better. And frankly, we've been operating so far in some of the most expensive markets in the US. Like if you had to pick markets where to start Shift, San Francisco would not be that market, given the fact that real estate here is super expensive and labor.
But you did.
We did, but I mean, that's because I think through that component of it when I was getting started. We picked San Francisco because from the technology company building perspective, it made the most sense. But, in hindsight, if I knew everything today that I knew, if I knew everything back then that I know today, I would have probably opened the technology hub in San Francisco, and the operations kind of market, the first market we started selling cars in, would have been somewhere other than San Francisco. Now, San Francisco has a lot of advantages to be the first market because you have a lot of early adopters, but it's not, cost-wise, it's not the best place to be. And so if we had realized how big operations would be for us, and the fact that we've been bringing it all in-house, maybe we would not have picked San Francisco. Now, the reality is we have a massive business in San Francisco, and that it works great, and that's awesome. But I think my point is that as we launch new markets, they're all going to be cheaper than San Francisco, except for New York. And so your average cost of labor and average cost of real estate, et cetera, will all come down because we already are in the most expensive place you can be in.
You had mentioned earlier the increasing margin that you're seeing on F&I. At what point does F&I become just the bulk of the margin to where you're cost competitive and that margin goes away on sort of the wedge between your acquisition and sale price, with the exception of F&I? Is that really just the problem in that 1 to 3 year old category you talked about, or is F&I something that could grow big in conjunction with?
F&I is something that can grow big. I mean, we talk about our midterm target of somewhere between $1,200 and $1,400 per unit in F&I.
For F&I.
Yeah. So we're like in Q4, we're at 790. So we still, I believe there's a ton of growth opportunity in F&I. And a really good dealer is in the kind of $1,500 to $1,700 range per unit. An average to good dealer, so not like an average dealer, but like slightly better, is like in the kind of $1,300 to $1,400. So when we say $1,200 to $1,400, we're not trying to like go after some totally unachievable number. It's actually a very achievable number for us in the next 2 years. So our midterm, that's kind of like early 2023 target, is something like $1,200 to $1,400 in F&I. So it is very much a huge focus for the business and what we do. We've seen really great growth on it so far, and I think we'll continue to see that.
You're projecting a double.
Yeah, well, up to double.
Roughly.
Yeah.
Okay.
So and then that's going to be a big component of your profitability as a business, no question. But you can't not make any money on the front end. You have to do well on the front end as well, in addition to the back end, to have a good business. I do think it's also important to note that all the numbers in F&I that I mentioned are using the current model that we call indirect financing. So Shift does not have a captive financing business like a Carmax or a Carvana. You can do a lot better in F&I if you have a captive financing business. So that's why Carvana might be in the kind of $2,000 to $2,500 in F&I versus what we're talking about, because they have a captive business. Same thing with CarMax. They have a captive business which generates something like $800 to $1,000 per unit as well. So it's kind of like an additional opportunity, but that's more long-term opportunity, not the medium-term opportunity.
I mean, so that's interesting, because you're thinking you can double your F&I now, but then if you add captive in the future, you could potentially up to double again after that.
Correct.
Right, gotcha. So, and then the front end margins, are you seeing compression here? I mean, obviously this pandemic has been wonderful in used car pricing. Everything's just been going up. But there's
but it has had auxiliary outcomes that have been good for some companies.
Gotcha. So, I mean, so this front end margin though, do you see this growing substantially? Like, what's your average front end now, and what's your projection there?
For Shifted, I mean, we are projecting, kind of a continued improvement in our front end margin as time goes by. There are really two core things that we need to do to get our front end margin to be better. Number one is we got to get our reconditioning costs to be lower. And we talked about that, labor costs, parts costs, and productivity. As those increase, that's a big component of that. We think there is, somewhere between, I'm going to give a number, but there's a reasonably strong amount of improvement that you can see in reconditioning costs. Our peers one of our peers is in the kind of $800 to $900 range on recon costs. And that's kind of the number we are striving to achieve over time as well. And then secondly is kind of price to market, which is what do people pay for a car versus where the car is listed for by every other dealer. So dealers list cars at a certain price and they have negotiations because they kind of haggle to a lower price. We have a single price, so we kind of list it at whatever price we sell. We have peers who sell for a lot higher price to market than we do because they have a much stronger brand. And so as we build our brand, our expectation would be that our price to market goes up, and that's an additional kind of front end margin improvement. So we want to get to kind of $1,100 to $1,300 in front end margin. We're not there yet, but that's a midterm target for us as well. So kind of our overall view is at the midterm point, which is like somewhere in time in kind of 2023 range, we want to be at $2,500 in gross profit per unit. And then beyond that, you can go to like, $3,000, $3,500 in gross profit per unit with a captive financing business or a service business, right? Like doing oil change and tire changes and things like that traditional dealers do that we don't, where there's a lot of opportunity. But that's more long-term. In the immediate kind of next couple of years term, we are looking at that $2,500 number with, $1,100 to $1,300 in front end and $1,200 to $1,400 on the back end.
And now, are a lot of these upsells, are they done through the app, or are they done when that employee comes? Do we have to teach employees, that is, how to sell F&I?
It's both. So our concierge are not salespeople. This is really important to kind of mention. They do not do any selling of anything. They are not car experts. They are drivers who bring the car to you. They are very friendly. They're customer service focused. They're not in the sales business at all. We do have a sales team that we call purchase advisors that are available by phone, and they do engage in a kind of phone conversation around a transaction for those consumers that need it or where we think there's a need for a conversation. But you can buy all these products completely digitally without ever talking to a human being, whether it's on your computer or an iPad device, or when the driver brings you the car, he'll have an iPad or she'll have an iPad with them, and you could apply for financing on that as well. Kind of having this no touch loan and add-ons purchase experience has been really critical for us, and it's a magical part of our experience, and we will continue to have it. Now, that is not, look, some people need a conversation, right? And if you have good credit, it's easier to get financing fully digitally. If you have worse credit, there might need to be a human intervention, because we might need to check on things that are harder to check on through software, because there's exceptions, and writing a code for every exception might not be the best use of time in the immediate term. But we do have a fully integrated digital way to buy add-ons and to get financing approved.
Got it. Two final questions that I have for you. A few months ago, the share price had, and we're not going to talk about price, but your share price had fallen in the 6s after the SPAC process. A lot of you executives bought shares. Why?
I think we thought it was a good investment, right? That's why people buy stock. And so I think that was what we believe to be true. Again, I try not to comment on those kinds of things, because I kind of don't want to be in any way even close to what I'm allowed and not allowed to say. So people should make their own decisions on that. But, we thought it was a good investment.
Can you say if this was something that was automated? Because sometimes you have the attendee plans with the SEC.
We haven't yet done that.
Okay.
So
okay.
When you do
that was not automated.
Yeah, when you do a SPAC process, you have to wait for a year before you can start doing a 10b5 plan. So it's just kind of, there's a bunch of securities rules involved, but like in a SPAC transaction, executive teams cannot set up those plans for 12 months post-transaction date. And so in our case, we just couldn't do that yet. And so we have open trading windows for employees, and during that open trading windows when we did.
Got it. Okay, then the last one is, right now it seems like, at least on the terminal here, it looks like you've got somewhere around 233 million in cash. What are the cash needs going to be here going forward, and any potential that we're going to have to, raise more funding with the advertising expenses coming up?
We have plenty of cash for this year, and for next year, we feel really good about where we are. Obviously, we always evaluate the market, and if opportunities present themselves, we might do some things. But at this point, we have no plans to raise cash.
Okay, that brings up one final one. Sorry, partnerships or acquisitions. Is that something you would even consider?
Not a focus at all. We got so much opportunity on our own. It's kind of like I get asked, like, when are you going abroad? And I'm like, we have nearly $1 trillion market in the United States to deal with, and there's like a ton of states to go into in the US. So we're not going to go abroad anytime soon. There's also no companies to buy. Obviously, we'll always explore opportunities if they present themselves, but our focus is on kind of organic core growth, which is what we're doing, and there's just a ton of growth to be had, and we want to take advantage of it as much as we can.
That's incredible. Golly, well, thank you so much for taking the time to come on here and share your thoughts with me. Appreciate that, and everybody viewing. Any final thoughts you want to leave off with? Any shout out? Obviously, Shift and the App Store.
No, it was awesome to talk to you, and folks should go to shift.com and check out our product and our experience. I think it's pretty awesome.
Awesome. Perfect. Stand by for one moment. For everybody watching, thank you so much for watching. If you've found this helpful, consider liking, sharing, and subscribing.